Next time you're stood at the pump watching £80 disappear from your account for a full tank, here's something that might surprise you. The person who owns that petrol station is probably one of the few people in that entire transaction who isn't getting rich off your money. Most Britons assume filling stations print money, prime location, captive customers, no real choice but to pay whatever's on the sign. The reality, according to the Competition and Markets Authority's own analysis, is that the fuel itself is often the least profitable thing on the forecourt. On an average litre of petrol in the UK, roughly 53 pence goes straight to the Treasury in fuel duty before VAT is even added on top. And once wholesale costs are stripped out, the retailer is frequently left with somewhere between 10 and 14 pence per litre to cover wages, business rates, card fees, and everything else. So, if petrol stations aren't getting rich from petrol, where exactly is the money actually coming from? And why are private equity firms still paying record prices to buy them? That's what we're about to find out. Britain's relationship to the petrol station has been quietly shrinking for decades. In 1990, there were close to 19,000 filling stations dotted across the UK. Today, according to the Petrol Retailers Association, that number has fallen to around 8,300. Fewer sites doesn't mean a smaller industry, quite the opposite. Total UK fuel sales were worth roughly £61 billion in the most recent full year of data, shifting around 16.5 billion litres of petrol and 21 billion litres of diesel. Strip the fuel out altogether, and the convenience stores attached to those forecourts turned over a further £5.3 billion last year, according to the Association of Convenience Stores, a figure growing faster than the rest of the convenience sector. The whole industry supports somewhere around 85,000 jobs. Here's the twist most drivers never clock though. Supermarkets operate only 16% of Britain's forecourts, yet they sell close to 44% of all the fuel, because their scale lets them undercut everyone else on price. That leaves the remaining 84% of sites, independents, oil company branded dealers and motorway operators, fighting over a shrinking slice of fuel volume while leaning ever harder on everything else they sell to stay afloat. So, what does it actually cost to get into this business? It depends enormously on the route you take. Buy an existing freehold forecourt outright, neighbourhood sites typically start from around £300,000, while a well-located motorway service site can comfortably exceed £1 million. And according to property agents Christie & Co., average forecourt sales prices have climbed 69% over just the past 5 years, driven as much by redevelopment and EV charging potential as by fuel. There's a cheaper way in, though. Rather than buying a site outright, you can become a dealer or contract manager under one of the major brands. Shell's retailer scheme, for instance, asks for a total initial investment of around £138,000, covering shop stock and working capital, with no separate franchise fee, in exchange for a share of fuel and shop profits. Whichever route you choose, you'll need a petroleum storage certificate, a local authority filling station license, regular trading standards pump testing, food hygiene and alcohol licenses if you're running a shop, environmental permits for the underground tanks, and insurance covering everything from fire risk to forecourt liability. Add staffing on top, and you're looking at a business that demands serious capital before a single car ever pulls onto the forecourt. Here's where the myth really falls apart though. Most customers assume the bulk of what they pay at the pump goes to the petrol station. In truth, on a litre priced around £1.20, taxation alone, fuel duty plus VAT, accounts for roughly 65% of that figure, climbing past 70% at higher price points. Of what's left, most goes to the oil companies, refiners, and fuel distributors further up the chain. The retailer's actual cut, the gap between what it pays wholesale and what it charges you, is known in the trade as the retail spread, and the latest CMA monitoring data puts that spread at around 14 pence per litre on petrol and just under 15 pence on diesel over the past year. That sounds reasonable until you remember it has to cover wages, rent, card processing fees, energy bills, and equipment that can cost tens of thousands of pounds to replace. Compare it to the pre-2020 average of roughly 6 to 7 pence per litre, and you can see why the CMA has flagged margins as persistently high, and also why retailers insist their own costs have risen just as fast. The honest answer is that fuel barely breaks even for plenty of sites. The shop is where the real money lives. Strip the numbers down further and the picture sharpens. Non-supermarket retailers reported an average fuel margin of around 9.8% of pump price in the first half of 2025, up from 9.2% the year before. But that's revenue, not profit, and operating costs eat into it fast. Independents without the buying power of the supermarkets or the big forecourt groups often see their actual fuel profit compressed to a fraction of a penny per litre, which is exactly why so many have either sold up or rebuilt their entire business around the shop. Convenience retail, by contrast, runs gross margins of 25 to 30%, 3 or 4 times more profitable litre for litre than fuel. Net profit, after wages, business rates, energy and finance costs, tends to land somewhere between 2 and 6% of total site turnover, rising towards the top of that range for sites with a strong food-to-go and shop offer. Let's put real numbers against 3 types of owner. Take a small independent leasehold site in a market town, shifting 2 to 3 million litres of fuel a year alongside a modest shop. Getting in might cost anywhere from £150,000 to £300,000 once lease assignment, stock and working capital are accounted for. After fuel margin, shop sales, wages and business rates, the owner-operator is often left with somewhere between £30,000 and £55,000 a year. For a 60 or 70-hour week, closer to a manager's salary than an entrepreneur's fortune, which is exactly why so many in the trade call it a way-of-life business rather than a wealth-building one. Now take a medium-sized, branded freehold site with a proper food-to-go counter. A real example from this year. Roadside paid £3.9 million for the freehold of a Gloucestershire filling station handling around 4.5 million litres of fuel annually, alongside a Morrison's daily convenience store. That site generated a profit before tax of £373,000 in the year to June 2025. A healthy return, but one built on years of investment in the shop, not the pumps. At the top end sit the multi-site groups. Motor Fuel Group, now Britain's largest independent forecourt operator with around 1,200 sites following its £2.5 billion purchase of Morrison's forecourt estate, doesn't make money one tank at a time. It makes money through scale. Centralised fuel buying, franchise arrangements with contract managers who run individual sites, and partnerships with Greggs, Costa, Subway and Londis that turn every forecourt into a mini high street. Earnings for individual contract managers vary hugely by site, but industry reporting suggests a well-located branded site can net its operator anywhere from under £40,000 in a quiet year to well over £90,000 in a strong one. The smartest operators have largely stopped thinking of themselves as fuel retailers at all. Parcel collection points, now offered at almost 30% of UK forecourts, bring in steady commission for almost no overhead. Car washes and valeting can add tens of thousands a year in pure profit because the kit runs largely unattended once installed. Lottery terminals, ATM commissions, and tobacco and vape sales, soon to require their own licensing fees under proposed government legislation, all chip in small but reliable margins. Then there's EV charging, with over 85,000 charge points now live across roughly 43,000 UK locations. Forecourts that installed ultra-rapid chargers early are starting to monetize a customer base that barely existed 5 years ago. And underpinning all of it is the land itself. A forecourt on a main road is quietly also a long-term property bet. None of this comes without serious risk, though. The number of UK forecourts has been in near continuous decline since the 90s, squeezed by supermarket buying power and rising compliance costs. The drive towards net zero by 2050, alongside the planned phase-out of new petrol and diesel car sales, means today's fuel volumes aren't guaranteed long-term, even if that shift is happening more slowly than some predicted. Business rates, the national living wage, and employer national insurance contributions have all risen sharply since recent budgets, hitting forecourts particularly hard given their staffing needs for round-the-clock trading. Crime is growing and an expensive problem too. Drive-offs, theft and assaults on staff have pushed many operators into costly ANPR and facial recognition systems. And regulators are watching. The CMA's repeated findings of persistently high margins have already triggered a new fuel price monitoring scheme, with further intervention not ruled out. For independents specifically, simply being outmuscled by bigger, better-funded rivals remains the single biggest threat of all. So how much does a UK petrol station owner actually make? For the small independent working all hours behind the till, it's typically somewhere in the £30,000 to £60,000 range, solid but hardly the goldmine the forecourt's prime location might suggest. For a well-run, branded site with a strong shop and food-to-go offer, six-figure profits are realistic, but only because that owner has quietly stopped relying on fuel to make their money. And for the handful of groups running hundreds or thousands of sites, the real profit comes from scale, property and partnerships, not pence per litre margins. Whether it's worth it depends entirely on which of those three businesses you're actually running, because despite what the sign on the canopy says, fewer and fewer of Britain's filling stations are at heart in the petrol business at all.